Hello everyone, John AG here, and I need you to hear this clearly. What you've watched in silver so far is not the move. It's the market stretching its legs before the sprint. The real breakout, the one that rewrites portfolios and humiliates the headlines, hasn't even shown up yet. And if you blink, you'll miss the quiet clues that are already stacking up right in front of us. Some of you clicked because you want price targets. Some of you clicked because you feel the economy is getting weird. And some of you clicked because you're tired of being told everything is fine while your grocery bill tells a different story. Good, because today we're going to connect the dots the way most people refuse to. We'll talk about why silver still looks like one of the most underpriced, most politically inconvenient assets on the planet. We'll talk about why the debt market is the real puppet master behind almost every surprise move you see. And we'll talk about the shift happening under your feet, where money becomes more digital, more programmable, and more controlled, while hard assets quietly become more valuable. Now listen, quick favor, and I'll get right into it. I'm running a campaign to wipe out copycat channels that recycle other people's work, and the only way it works is if the real community shows up. If you value what I do here, hit subscribe and drop a short comment. Literally type Arjun AG so the algorithm knows you're with me. And while you're here, I want you to know this. My analytics show a huge percentage of viewers watch the full videos but never subscribe. If you're one of them, fix that today. It costs you nothing, but it keeps this channel alive. Okay, one more tool that helps you daily. I've created a WhatsApp channel where I drop fast updates, short posts, and personal analysis that I don't put on YouTube, plus instant voice notes when something breaks suddenly. If you want daily videos, quick alerts, and those premium community updates, the link is in the description. Join it now so you're not late when the market moves while you're asleep. Alright, let's set the stage with something practical, because I know some of you want options, not just big ideas. If you're building a physical position, you've probably noticed premiums have a personality. One week it's calm, the next week it's chaos. This week, the market has been offering familiar choices, small fractional gold coins priced at a tight premium over melt, brand new 1-ounce silver coins priced at a fixed amount over spot, and olders at 90% half dollars priced by the ounce. I'm not giving phone numbers here, and I'm not telling you buy this exact thing. I'm telling you what matters. Watch premiums, watch availability, and watch how fast product disappears. Because scarcity shows up in the real world before it shows up in a chart. Now here's the core idea that changes everything. Most people talk about silver like it is a normal commodity that goes up when inflation goes up and goes down when rates go up. That's the kindergarten version. Silver is not just a metal. Silver is a stress indicator. It is a report card on confidence. It is a loud, shiny critique of paper systems, and that's why it has been pushed down, talked down, and turned into a punchline for decades. Because if silver ever trades like a truthful asset, it doesn't just hurt traders, it embarrasses institutions. It reminds normal people that the perfect system is built on claims, not on reality. So I spent time this week reviewing the arguments from a veteran market watcher, someone who's tracked leverage cycles, debt dynamics, and currency behavior through multiple regimes. And the message was not cute, it was blunt. We've barely scratched the surface, not tomorrow it moons. Not next week it's over. Just a calm reminder that what you're seeing right now looks like the early tremor, not the earthquake. Here's why. The real driver isn't a headline. The real driver is the debt market, because the debt market is where the entire system either survives or breaks. Stocks can be floated, narratives can be manufactured, statistics can be massaged. But the debt market, that thing is a monster, and when it turns, it drags everything behind it like a chain. Let me simplify the engine in one sentence. The modern system survives by expanding debt and suppressing the cost of debt. That's it. That's the trick. When money's cheap, everything looks healthy, companies refinance, governments, and it creates a world where the only way to keep up is to take on more risk. So what happens when the engine starts coughing? What happens when the cost of money rises? Or when buyers of debt step away? Or when a refinancing wave hits at the wrong time? That's when solutions get ugly, and when solutions get ugly, silver stops being an investment and starts being a lifeboat. Now I want to talk about something that sounds small but isn't. The mental shift. I speak to smart people all the time. Educated, hardworking, responsible, and when they buy their first precious metal, they feel weird. They feel like they're doing something risky, like they're sneaking out of class. That is conditioning. For decades, people were trained to believe a number on a screen is safer than something you can hold. They were trained to believe safety means permission. Permission from banks, permission from apps, permission from policies, and the first time you step outside that story, your body reacts. Your brain says this is unfamiliar, so it must be dangerous. But here's the twist. Unfamiliar doesn't mean unsafe. Unfamiliar just means you weren't taught it. That's why the first purchase is always the hardest, because you're not fighting math. You're fighting a mental cage. You were taught to trust promises. You were taught to trust accounts. You were taught to trust statements. But an account is a claim, not a possession. A statement is a story, not an asset. When the system is calm, that difference feels academic. When the system cracks, that difference becomes everything. And this is where people ask me the same question in 100 ways. Should I wait for a pullback? I get it. Everyone wants to be the genius who buys the exact bottom. But here's the honest answer. Most people who wait for the perfect entry don't end up with more metal. They end up with more excuses. They spend months watching, refreshing, hesitating, and then when the move happens, they panic, buy higher, or they freeze again and miss it entirely. So what is the real risk? Is the risk that silver wiggles down for a week? Or is the risk that you spend the next 2 years waiting for a perfect price while the world shifts from a paper trust era into a hard asset era? Volatility is annoying. Delay is lethal. Now let's address the biggest trap, the mainstream narrative machine. Whenever metals get interesting, the financial media suddenly discovers a reason why you should not buy. It's always something technical sounding. It's always something temporary. It's always something that makes you feel like you're late or foolish or reckless. One week it's too much supply. Next week it's a strong dollar. Next week it's higher rates. Next week it's ETF flows. Next week it's positioning. Oh, next week it's seasonality. And if you chase every explanation, you'll never act because the goal isn't to inform you. The goal is to keep you in the herd. And the reason they don't want regular people owning physical should be obvious. Every unit of currency you convert into metal is a unit they can't easily funnel back into fees, products, and control systems. Physical is annoying to an industry built on intermediaries. Now, I'm not saying every journalist is evil. I'm saying the incentives are what they are. If your business is selling paper products and keeping people in the system, you're not going to encourage people to exit the system into something they can hold privately. So yes, you'll see expert stories warning about massive selling pressure or technical headwinds or rebalancing events or rollovers, and some of those things cause short-term noise. But the bigger question is this: does short-term noise change the long-term math? No, because long-term math is about debt levels, currency dilution, and trust. Now let's connect dots that most people ignore. The world has been trained to believe the currency is stable because it has a flag on it. But currency stability comes from purchasing power. It comes from discipline. It comes from balance sheets that make sense. And it comes from people believing tomorrow won't be worse than today. When those ingredients fade, the public doesn't notice at first. They adapt quietly. They cut corners. They trade down. They postpone plans. They accept less. Then one day, they notice the truth all at once. And that's when trust breaks fast. That is the moment silver is waiting for. Now, I want to get specific without turning this into a textbook. If you want to track whether the pressure is building, stop watching only price. Watch behavior. Watch how fast coin inventory disappears after a dip. Watch whether backorder becomes a normal word again. Watch whether delivery delays start showing up in places you didn't expect. Watch whether the futures curve starts doing strange things like paying you more to delay delivery or sometimes even paying you less because the market wants metal now. Watch whether borrowing costs and share lending around silver-linked products spike. You don't need to be a wizard. You just need to notice when the system gets nervous because nervous systems leak information. And here's a cliffhanger most people won't anticipate. The next big silver move may not start with silver at all. It may start with the bond market refusing to behave. It may start with yields breaking ranges that policymakers can't tolerate. It may start with a sudden pivot where the public is told one thing in the morning and the opposite thing at night. It may start with a liquidity event that gets described as temporary, and in those moments, silver doesn't ask permission, it reprices. This is why I keep saying watch the debt market. The debt market is the lever, and whoever controls the lever controls the story until the lever snaps. Now let me tell you a quick story that illustrates the paralysis problem. A while back, someone I know had extra cash sitting around, not huge money, but meaningful. And at the time, silver was cheap enough that you could build a real position without feeling like you needed a second job. I suggested buying a little at a time. He didn't, not because he lacked intelligence, because he lacked permission. He wanted a perfect confirmation. He wanted the news to say it was safe. He wanted the market to clap. Then the price moved and suddenly he was interested. But now he was worried he was late. Then it moved again. And now he was waiting for a pullback. That's the loop. And the loop exists to keep you from owning real things until they're expensive. Now I want you to understand something that might sound harsh but saves people. You can be right and still miss the benefit if you can't act. So the strategy isn't to predict the future. The strategy is build a position that survives multiple futures. Now, another part of this conversation is uncomfortable. What would it take to truly restore purchasing power? In theory, you could defend a currency by making money expensive, raising rates hard, letting bad debt fail,